give and take there. All right, so let's switch gears. The national debt. This is something that, I've heard about ever since I got in this business. For a long time, people have been talking about the national debt. And, when you look at how much the national debt is right now, $35 trillion. I mean, that's a lot of numbers on that page. And that number keeps going up. And so we know this is something that, especially in a political year, that's going to get some headlines. It's going to be talked about. But the question comes down to, is this really an issue that you should care about? And I don't want to say care about, but is this an issue that's really going to negatively impact your retirement, your financial goals, and is something that you should, be building your portfolio around worrying about the national debt? And there was a great video by Mike Antonelli, who's he's a strategist with Baird. He did this video that you can find on YouTube. I'll make sure to link it in the description below, but did a great video breaking down the national debt. And it was a really good video because it puts in perspective, okay, how long have we been worrying about this debt? And, he showed some cartoons, and hopefully you're able to take the time to watch, but showed some things from, the 18 and 1900s that we were talking about this national debt issue for over 100 years. I mean, this isn't something that's new. It's not like, poof, the national debt got to 35 trillion just out of the gate. And so, there's a bad perception of what the national debt is. A lot of people like to equate it to personal debt. You go out and you've got a credit card or a home loan, and you add on a car loan. Now you start feeling some of that pressure of, well, you need to make sure that your income is keeping pace with what that debt is going to be or what that debt is for you personally. That's not how the U.S. operates. We're not, yes, assets have to rise with debt, but they are rising. We're seeing that with GDP. We're seeing that, just with the asset that the U.S. government has, which is one, we issue, the currency that the debt is issued in. So we have the ability to print our way out of this. And I know that, a lot of people don't necessarily like to think about, the U.S., printing a bunch of money. And, there's a lot of misconceptions on whether that's good or bad. But the reality is, it is the reality. We have the ability to do that, which a lot of countries don't. And so then you hear about things like the debt ceiling. These are things that we're going to hear about, especially it seems like every year, every couple of years, we always hear about the debt ceiling. The U.S. is going to shut down the government. Well, that's a self-imposed, political constraint. That's a political maneuver that our politicians are doing. That's not something that, the international community is saying, okay, well, you guys are taking out too much debt, and, we're not going to continue to buy this debt. Because you got to remember, the U.S., we can't go bankrupt. We have the ability to print money, and print the money to meet our obligations. Now, could that be inflationary? Yes, it probably will be inflationary. And, that's where, when you're positioning your portfolio, the goal is to make sure that you're positioned for inflation, but where I see a lot of people who are focused on retirement think about the debt in the wrong way is they look at this and say, well, the U.S. is going to go bankrupt. I should take my money and I'm going to put it all into gold, or I'm going to put it all into real estate, or all into one sort of hard asset. And, the reality is that the U.S. dollar is the world reserve currency, and it's still held by, the majority of the international community as that world reserve currency. It's the number one currency that's out there. So from a power perspective, it's an extremely powerful tool to be able to print that. And when we think about, the thought process of, okay, let me take all my money, I'm going to put it into gold, or I'm going to put it into a house, or, whatever it is. I always think about it like this. If you ever have to go to a store, or you have to buy something, and to do so, you had to shake off fleck off a shilling of gold to pay for that, then the reality is none of this matters. None of what we see today as an actual, economy matters. It's all gone, because if we had to go back to a currency that is, in coin form or in bar form, then I could tell you that, the money that you had in the bank is gone. The bank's probably gone. Everything is at that point completely changed. It's one of those fears that I see a lot of people worry about, that I think can, hopefully be alleviated by thinking through that of what kind of world would we actually be in if we had to use some sort of hard asset as our currency? So it would take a catastrophic thing to get us there. But I do think that we're in a position where, yeah, the US debt does have to change. Something has to happen there. But the reality is, it's not like we're in these dire straits. When you look at the US debt to GDP ratio compared to other developed nations, we're not too bad. We're not too far off. I mean, look at Japan, and obviously Japan just created some ripples over the past couple of days, but we're below the average. And so, yeah, it's not great to see these massive numbers of debt. And so, at some point, some of the stuff is going to get reined in, but it's a powerful tool, and it's a way that we can utilize something that utilize the asset of debt to build out the infrastructure in our country. So it is something that I think is always going to be on people's mind. It always has been for hundreds of years. This is something that people, they mentioned that video, Andrew Jackson, who's on the $20 bill. He had such a big issue with the U.S. debt. And that's going back to the guy who's on the $20 bill. So I don't think this is going to be something that's going to go away overnight. And the last thing that you want to do is build your entire retirement portfolio for something that is going to continue to happen probably well after we're all gone. And so when we think about the ability that the U.S. government has, I mean, think about the asset. How much would you value the asset to be able to tax the most highly productive economy? I mean, that is just a tremendous value. Now, obviously, as a U.S. citizen, we all don't want to think about this, government coming down and taxing us, extreme amounts just to pay off the debt. But it is an asset that they have, and it's something that they can actually do. And unfortunately, there's nothing that we can vote with our at the ballots, but that's really all we could do. So they have this asset, that they can tax this highly productive economy in the currency they issue the debt in. They have the ability to print the debt. So when you're building out your portfolio, yeah, you might want to think about, making sure that it's built to keep pace with inflation, built from an inflationary hedge standpoint. Those are ways you can think about it. But, to take your portfolio and do things that are, extreme because of a worry about the debt, you think about how much the US debt has grown over the last 100 years. I mean, it's grown tremendously, but also think about the value of how much the U.S. economy and the U.S. stock market has grown over that time as well. I would imagine that Steve Jobs wasn't sitting there thinking, well, maybe we shouldn't, put out the iPhone because, the U.S. is in a ton of debt, and why would we do that? Or, I'm pretty sure that, Mark Zuckerberg wasn't thinking, let's not, start this Facebook thing because, hey, the U.S. debt, we got to focus on that. The economy is still going to continue to grow. People are still going to want to grow and spend money, and businesses are going to want to thrive. We are in an economy that is a capitalistic society, and so people are going to be entrepreneurial in spirit and continue to grow. So just think about that as you're building out your investment portfolio, because it's important to make sure that you're keeping things in perspective, especially from a retirement standpoint. The last thing that you want to do is, create such a rigor around your portfolio, or these extreme rules around, within your portfolio that are not allowing for this long-term growth. There's always going to be concerns. We're seeing that live out right now, but we've seen that live out for a long period of time. So, a lot of different things to take away, but check out that video. I think it creates a good perspective on what's going on in the, with the debt and how you should be thinking about it. And then you think about, as I mentioned, during that time, stocks continue to rise over the past 100 years, economy continue to grow. And the last thing that is probably the most important, if you were investing based on the debt, that would be extremely frustrating and underperforming. And you probably saw that if that's something you did. I mean, we talk about, I mentioned gold because a lot of people have this, assumption that gold is a great hedge for inflation. And if you look at the actual data, the best hedge for inflation has actually been U.S. stocks. That data goes back, dozens and dozens of years. So it's something that, when you're thinking about constructing your portfolio, the simpler that you can make it, that's based around your goals and not around something like, the national debt, the more successful you're probably going to be, and the less headaches you're going to have, the more, I would say the more enjoyable that retirement is likely to be. So, but that's enough on the U.S. debt. We can kind of ramble on for a long time.